Welcome to the Battlefield Trading YouTube channel. In today's video, we'll explore a crucial tool in technical stock analysis, the Japanese candlestick chart. This is not just a useful tool, but also a language of the financial markets, helping us understand past price movements and predict future trends. Many of you may have heard of Japanese candlestick charts, but might not fully understand how to read and apply them in trading decisions. In this video, we will cover the structure and components of Japanese candlestick charts, how to use candlesticks to analyze price action and market trends in detail, 7 highly effective candlestick patterns and the price behavior behind them, how to combine candlestick patterns with support and resistance levels, as well as trend lines to analyze price action when trading. If you're a beginner or looking to improve your technical analysis skills, this is a great opportunity to learn about a powerful tool in your trading arsenal. Let's dive into the world of Japanese candlestick charts and strengthen your trading strategy. We'll get started right after this introduction.
Warning.
Let's start with the definition of the Japanese candlestick chart. A Japanese candlestick chart is a type of technical analysis chart that represents the price movement of a financial asset over time. It uses candlesticks to display the opening price, closing price, highest price, and lowest price within each trading session. If we look at a daily candlestick chart, a single candlestick represents all price action within one trading day. There are 2 types of candlesticks: green, bullish, and red, bearish. A green candlestick forms when the closing price is higher than the opening price, indicating that buyers were stronger than sellers. A red candlestick forms when the closing price is lower than the opening price, showing that sellers dominated over buyers. The popularity of Japanese candlestick charts is no coincidence. They provide traders with a clearer understanding of price movements. Each candlestick consists of 2 main parts. The body represents the difference between the opening and closing prices during the trading session. The wick, shadow, shows the highest and lowest prices reached during the session. Upper wick indicates the highest price reached. Lower wick indicates the lowest price reached. Candlestick body differences. In a green candle, the bottom of the body is the opening price and the top is the closing price. In a red candle, the top of the body is the opening price and the bottom is the closing price. Before moving on to candlestick patterns, we need to understand a few key concepts. Large candlestick body versus small candlestick body. The size of a candlestick body is often used to describe price movement and trend strength in Japanese candlestick charts. Here are the key characteristics of large and small candlestick bodies. Large candlestick body. A large candlestick body indicates a significant difference between the opening and closing prices. A bullish, green candlestick with a large body typically shows strong buying pressure. A bearish, red candlestick with a large body indicates strong selling pressure. Small candlestick body. A small candlestick body represents a minor difference between the opening and closing prices. This suggests that neither buyers nor sellers have overwhelming control. A bullish candlestick with a small body indicates moderate buying pressure, but not complete dominance over sellers. A bearish candlestick with a small body suggests that selling pressure exists, but is not significantly stronger than buying pressure. The size of the candlestick body is often used to assess market momentum. A large body can indicate increasing momentum in a trend. A small body may suggest weakening momentum or indecision among market participants. Both types of candlesticks provide valuable insights into price movements and the behavior of buyers and sellers in the market. Example. In this example, we have 2 green candlesticks. The one on the left has a large body and relatively small wicks. The opening price is here. Initially, sellers attempted to push the price down, but their selling pressure was weak as buyers quickly stepped in and drove prices higher. Buyers were able to push the price significantly upward without facing much resistance from sellers. As a result, the closing price is very close to the session's high, indicating that buyers were significantly stronger than sellers. In the second candlestick, the story is entirely different. The opening price is here, and buyers initially push the price to a new high. However, at the highest price point, sellers step in and drag the price down. Sellers strongly push the price back close to the opening level, but ultimately, buyers manage to keep the closing price higher than the opening price. In this case, we can see that buyers are still stronger than sellers, but the difference in strength is minimal. When the candlestick body is relatively larger than the wicks, it indicates that either buyers or sellers, Rs, are in control. On the other hand, when the body is smaller than the wicks, it suggests a lack of clear control from either side, signaling a tense battle between buyers and sellers. 2 large wicks. Whenever we spot a large wick above or below the candlestick body, it provides a clear clue about price action. If there is a large upper wick, it indicates that sellers are aggressively selling at those levels. For the price to push higher, buyers will need significant effort. Conversely, if there is a large lower wick, it signals strong buying interest at lower price levels. If sellers want to push prices lower, they must overcome these buyers. The concepts of candlestick bodies and wicks are essential when using Japanese candlestick charts. Keep these in mind. And now, let's move on to some basic candlestick patterns. Basic candlestick patterns. Pattern number 1, bullish pin bar. A bullish pin bar is a strong reversal candlestick pattern that signals a potential trend reversal to the upside. A bullish pin bar consists of 3 key elements: a small green body, a long lower wick below the body, a small or non-existent upper wick. Understanding the price action behind the pattern. A bullish pin bar forms when the price opens around this area, and sellers immediately attempt to push the price lower. In fact, sellers initially succeed in driving the price down, but at some point, the low price triggers a wave of buying orders. We can see that buyers are stronger than sellers because they push the price back up beyond the opening price. Clearly, the price increase led by buyers surpasses the initial drop caused by sellers. This indicates that a significant number of buyers have entered the market, trying to capitalize on what they perceive as a favorable buying opportunity. If a bullish pin bar appears after a strong downtrend, it suggests that selling pressure is weakening and buyers are stepping in to push prices higher. Trading the bullish pin bar. Although the bullish pin bar is a strong reversal pattern, additional factors should be considered to confirm the trend reversal. If we identify a buying opportunity based on the pin bar and supporting factors, we can place a buy order above the high of the pin bar, set a stop loss below the low of the pin bar, set a take profit target below the first resistance level. Pattern number 2, bearish pin bar. The bearish pin bar is simply the opposite of the bullish pin bar. It signals a potential reversal from an uptrend to a downtrend. A bearish pin bar has 3 key characteristics: a small red body, a long upper wick above the body, a small or non-existent lower wick. Understanding the price action behind the pattern. The price opens at this level, and buyers initially push the price higher. They drive the price up significantly, forming a peak. However, at this peak level, sellers step in aggressively and push the price lower, even below the opening price. Sellers then continue to hold control, keeping the price near its lowest point by the time the candle closes. This price action indicates that sellers have gained the upper hand over buyers. A bearish pin bar appearing after a strong uptrend can be a reliable signal that momentum is shifting downward. Trading the bearish pin bar. If additional confirmation signals support the trend reversal, traders can place a sell order below the low of the pin bar, set a stop loss above the high of the pin bar, plan a take profit target at the next support level. Doji candlestick pattern. The doji candlestick is unique because it does not provide a clear directional bias. However, understanding this pattern is essential. Characteristics of a doji candlestick: a small body with the opening and closing prices nearly equal, upper and lower wicks of similar length. It represents a battle between buyers and sellers where neither side gains significant control. Understanding the price action behind a doji. During the period of the doji candle, sellers attempt to push the price down while buyers try to drive it up. However, by the close of the session, neither side dominates, and the price ends up near where it started. This indecision means that price direction remains uncertain. A single doji might indicate a temporary pause in the trend. Multiple consecutive doji candles suggest intense competition between buyers and sellers. Eventually, one side will gain control, leading to a strong breakout in either direction. Moving forward, multi-candlestick patterns. The three patterns discussed so far, bullish pin bar, bearish pin bar, and doji, are single candlestick patterns. Now let's move on to multi-candlestick patterns, which combine two or more candlesticks to provide stronger signals. Pattern number 4, bullish engulfing candle. The bullish engulfing pattern consists of two candlesticks, where a large green, bullish candle completely engulfs the previous red, bearish candle. Key characteristics of the bullish engulfing pattern. The first candle is a small red candle, showing that sellers were in control. The second candle is a large green candle, fully engulfing the previous red candle. The high of the green candle is higher than the previous red candle's high. The low of the green candle is lower than the previous red candle's low. Understanding the price action behind the pattern. Initially, sellers control the market, pushing the price down as seen in the red candle. However, at the low of the red candle, buyers aggressively step in, overpowering sellers and pushing the price beyond the previous high. This shift in control signals that buyers are now dominant and may push the price even higher. How to trade the bullish engulfing pattern. Entry point. A buy order can be placed once the price breaks above the high of the red candle. Stop loss. Set below the low of the green candle for risk management. Confirmation. Always use additional factors like support levels or trend lines to confirm the uptrend before entering a trade. Pattern number 5, bearish engulfing candle. The bearish engulfing pattern consists of two candlesticks, where a large red, bearish candle completely engulfs the previous green, bullish candle. Key characteristics of the bearish engulfing pattern. The first candle is a small green candle, showing that buyers were in control. The second candle is a large red candle, fully engulfing the previous green candle. The high of the red candle is higher than the previous green candle's high. The low of the red candle is lower than the previous green candle's low. Understanding the price action behind the pattern. Initially, buyers control the market, pushing the price up as seen in the green candle. However, at the high of the green candle, sellers aggressively step in, overpowering buyers and pushing the price below the previous low. This shift in control signals that sellers are now dominant and may push the price even lower. How to trade the bearish engulfing pattern. Entry point. A sell order can be placed once the price breaks below the low of the green candle. Stop loss. Set above the high of the red candle for risk management. Confirmation. Always use additional factors like resistance levels or trend lines to confirm the downtrend before entering a trade. Pattern number 6, Morning Star. The Morning Star pattern is a 3-candle bullish reversal pattern that signals a potential trend change from bearish to bullish. Key characteristics of the Morning Star pattern. 1. First candle, a large red bearish candle showing strong selling pressure. 2. Second candle, a small-bodied doji or pin bar, which can be red or green, indicating market indecision. 3. Third candle, a large green bullish candle breaking above the doji's high and confirming the reversal. Strength of the pattern. If the third green candle is equal in size to the first red candle, it signals a strong bullish reversal. If the third candle is smaller, the signal is weaker and may require further confirmation. If the third candle closes above the first red candle's high, it confirms a strong bullish breakout. Understanding the price action behind the pattern. The first red candle shows strong selling pressure and confirms that sellers are in control. The second small-bodied doji or pin bar represents market indecision, signaling that buyers are stepping in. The third large green candle confirms that buyers have taken control and are pushing the price higher. How to trade the Morning Star pattern. Entry point. Place a buy order above the high of the third green candle. Stop loss. Set below the doji candle for risk management. Confirmation. Use support levels, moving averages, or trend lines to validate the signal. Pattern number 7, Evening Star. The Evening Star pattern is the bearish counterpart to the Morning Star and signals a potential trend reversal from bullish to bearish. Key characteristics of the evening star pattern. 1. First candle, a large green bullish candle indicating strong buying pressure. 2. Second candle, a small-bodied doji or pin bar showing indecision between buyers and sellers. 3. Third candle, a large red bearish candle breaking below the doji's low and confirming the reversal. Understanding the price action behind the pattern. The first green candle shows that buyers are in control and pushing prices higher. The second doji candle signals indecision, meaning the buying momentum is weakening. The third large red candle confirms seller dominance and suggests a downtrend may follow. How to trade the evening star pattern. Entry point: place a sell order below the low of the third red candle. Stop loss: set above the doji candle to manage risk. Confirmation: look for additional resistance levels, trendline breaks, or bearish indicators before entering the trade. Now that we've covered 7 key candlestick patterns, the next step is learning how to combine them with support, resistance, and trend lines to find high probability trade entries. Example: using candlestick patterns in trading. Imagine price is in a downtrend, but we identify 2 previous reversals, marking it as a support level. Now, as price approaches this support for the 3rd time, we closely observe price action and candlestick formations. 1. Spotting reversal signs at support. First sign: as price nears support, red candles shrink, indicating sellers are losing momentum. Second sign: a doji candle forms at support, signaling buyer interest. Third sign: a large green candle appears, breaking above the doji's high, forming a morning star pattern. Trade setup: buy entry, above the green candle's high. Stop loss, below the doji's low. Take profit: first resistance level. 2. Identifying trendline break with engulfing pattern. When 2 peaks form, we draw a trend line and watch price behavior as it retests the trend line. A red candle forms, suggesting sellers are defending the trend line. A large green candle follows, completely engulfing the red candle's range. This is a bullish engulfing pattern, showing that buyers have taken control. Trade setup: buy entry, above the green candle's high. Stop loss: below the green candle's low. Both setups show how candlestick patterns plus key levels, support, trend lines equal strong trade opportunities. Example of a short trade. We observe that the price encounters resistance in this area. When the price rallies back to test the resistance for the 2nd time, it forms a bearish evening star pattern. The first candle is a strong green candle, indicating buying pressure. The second candle is a doji, showing indecision between buyers and sellers. The third candle is a large red candle, closing below the lows of the previous 2 candles. High probability setup. Since the red candle has a large body and closes significantly lower, this is a strong evening star pattern. Trade strategy. Enter a short position below the low of the red candle. Stop loss: place it above the high of the pattern. Take profit: target the nearest support zone. I hope this example helps you understand how to integrate candlestick patterns into real trading scenarios. Remember, candlestick patterns are just one part of a complete trading system and should be combined with other factors like support, resistance, and trend analysis for better accuracy. If you found this content useful, make sure to subscribe and turn on notifications to stay updated with the latest insights on financial markets. Wishing you success in your trading journey. Thank you, and see you next time.